Welcome to the big interview on this edition of Money Life. And joining me now, Fritz Folts. He is the chief investment strategist at 3 Edge Asset Management. If you want to learn more about him or the firm, it is 3 Edge, 3 the number 3, 3edgeam.com. Fritz Folts, great to have you back on Money Life.
Great to be here, Chuck. I always enjoy being on your show. So thanks for having me back.
Well, let's start with big picture right now, because, it's been about 6 months or so since you were last on the show. So if we go back to where we were as you and everybody else was looking ahead into 2025, what we were hearing was that we'd have a landing. What we were hearing was that the Fed would start cutting rates. What we weren't hearing was that the U.S. economy would stay stronger than anybody expected for longer than anyone could even imagine. So now all the things that everybody forecast did not come true. I guess that's not a big surprise given the economic growth we've had. But does that continue, or it's just taken longer to get to what everybody thought was going to happen?
That's a good question. I think my short answer to that is, remember at the beginning of the year, people were looking for 6 rate cuts from the Fed. And then we were, within the last few weeks, we had gotten to the point where people were saying they might need to hike, right? So now Chair Powell has stepped in and said, okay, looks like we're not going to have to hike. That's not going to be our first move. So that was a relief. And then with the CPI data we got at the middle of this week, people are maybe back to 2 cuts. So I think all we've done is delay the inevitable. I do think that as we get to the second half of this year, we will see the economy slow down. A recession call, not sure. But, I think that this monetary tightening will bite. The wild card, though, is going into the election. We could have very loose fiscal policy going into the election. So it could continue to last, but I would define it as we've put off the inevitable, because eventually we're going to get that recession.
I want to spend a moment talking about something that I know is not meaningful, but I'm curious. At the end of last week, the Dow was flirting with 40,000. And of all of the round numbers that the Dow has crossed in my lifetime, I'm not sure it's ever been quieter than 40,000, right? Like there was just nothing. Now, it didn't hold it on Thursday, and as we record this, we don't know if it's holding it on Friday. But for you, is there ever a time when a mile marker, which is what 40,000 is important? Is it meaningful in any way? And is it something that somebody should be looking at? We know there's this disconnect between what the market's telling us and how people feel. Is this that thing that goes, hey, wake up, it's not that bad?
Well, right. So, I think that this all plays into momentum, investor behavior. And, I recently just been writing a commentary that I just call the everything rally. Right? I mean, we just have the S&P 500 all-time highs, the Dow over 40,000. But it's not just in the U.S. You have Japanese equities reaching all-time highs. You have Europe. You have gold reaching all-time highs, commodities like copper. So we're just in the midst of having this everything rally where everything across asset classes, across geographies are going higher. And so, investors can look and say, wow, now we've broken 40,000. Why not 42? Why not 43,000? Why not 45,000? This is an everything rally. Of course, we also know that just when it seems like the only direction for the market is up, typically that doesn't augur well for the period ahead. It all plays into this idea that we're in a market that is momentum driven, it's investor behavior driven, it's fear of missing out. All of those things are driving this market. And so those milestones count if that's what you're looking at.
Is there something coming that, so many people are worried about significant trouble ahead, and there are warning signs, but are they warning signs or are they real danger signs?
Well, that's a good question. I mean, it's interesting because this past week, I picked up my Financial Times, and the front headline of the Times was how Starwood now had to dip into their borrowing facilities because they're getting redeemed and they need the liquidity. So to me, that's one of the things that we need to be careful and be on the lookout for. Do we see credit spreads start to widen out? do we see liquidity start to get extracted from the system? So we're invested. I mean, we're not at our minimum in terms of equities. We're not at our maximum. We're about right down the middle of the road. So we believe that you can participate in this rally, but we are hyper focused on looking for those signs of danger ahead, of potential potholes. And so, yeah, it's only one data point, but to see, a firm like Starwood with all the troubles in the real estate market having to dip into their credit facilities, you start to see a couple, two or three of those, and that can really start to cause headwinds in the market.
When you consider the numbers that we've seen, things like Starwood needing to dip into its credit facilities, well, what about just consumers having to change their habits? I mean, we've seen the numbers get to where they are scary, and yet we haven't seen whether it's consumers having significant defaults, whether it's junk bond getting junkier and the rest. We haven't seen that. Is that coming? Are we, do we have to go through a period like that?
I mean, I think we do. But I think everyone was wrong in terms of how far the consumer could go. And obviously, to the extent that they're maxing out their credit cards, that's not a good sign. But there was a lot of liquidity sloshing around in the system for an extended period of time. And that lasted much longer than I think anybody felt that it could. And a lot of it just, was the leftovers from the fiscal stimulus from the pandemic. And it just went on for a very long time. But I think that, if you're a student of market history, you have these periods that feel very familiar to this one, where you have a market that's melting up. You have, investors thinking, well, there's really nothing wrong. As they say, just when you feel safe, you're probably in the most danger. So that to me is just from my experience, when you're in an environment like this, you don't know what it's going to be, but it's going to happen. Something is going to go wrong out there. And it could be the consumer, it could be credit in corporate credits. Don't know, but I don't think we get away scot-free and have a no landing.
So the landing that we are getting, is that basically what we were expecting? Once the yield curve inverted, we were supposed to have a recession. It was going to take a while. It has taken longer than expected. But this is that playing out, or this is something else playing out? Because, again, with all the changes, what we've really done is we went from a position where people thought the Fed was going to make cuts because it wanted to make cuts, to where whenever the Fed moves, it's making moves because it has to make moves.
Yeah. So, I mean, as we know, historically, when you have the inverted yield curve, it can take a long period of time before that recession kicks in, but it's pretty reliable indicator. And as we also know, it's typically when the yield curve then flattens and begins to steepen right before you get that recession. So, I think all else being equal, if you go back through market history, it's a pretty strong indicator. It's pretty reliable. I think that we'll get a slowdown in the second half. We could get a recession in let's say the last quarter of this year, maybe the first of next. But regardless, I think we will get that economic slowdown that we all thought maybe was coming a little sooner than now.
What is your take for domestic versus international? I mean, on the one hand, you like what you see here, you like the numbers, but you see that there's a soft landing coming in the rest. On the other, the U.S. has still been the best market and the best economy in the world, even at times when people thought, yeah, it's not going to be that way for a while. It's still held that title. So how much are you encouraging people to be diversified with boots on the ground internationally?
Yeah, so we are global investors, and so the way we would say it is, listen, if you look at the U.S. market, and you can say this till you're blue in the face, that the U.S. market is significantly overvalued, and it is, but it continues to go up. So what we're doing is, well, can we find any equity markets that are less overvalued or even undervalued out there? So there are just extended periods of time where U.S. markets outperform. This has been an especially long one. But then there are also extended periods of time where non-U.S. markets outperform. If we see the dollar eventually begin, to relinquish some of the strength that it's had, we like the international equity markets. And the first thing that stands out is they're much better in terms of valuation, obviously, than the U.S. market. So we like Japan, we like India, We didn't really like Europe, but that hasn't really mattered, has it? Because it's continued to go up, even with all the problems that they've had there. So we think that there's better value out there in Europe, in Japan, in India, ex-US. And again, to the extent that the dollar can back off here, even in the emerging markets. So we're global investors. We look across the globe for opportunity, and we would at least want to have not all of our equity allocated in the US, at the very least have some of it allocated ex-US.
How much do you want to be dedicating to alternatives? How much do you want to stick with keeping it simple?
Well, can we do both? Can we keep it simple? So this is what I think a good way to describe our positioning here. And so we want to have targeted diversification because there is a myriad of scenarios that could play out. So we want to hold some gold and some tips to hedge against rate cuts or even stagflation or geopolitical conflicts. We also want to hold some short-term treasuries in case we get into that period of credit contraction where liquidity is extracted from the system. So as an ETF portfolio manager, there are liquid exchange traded funds, that represent a variety of asset classes that serve as alternatives, right? They serve because they have a lower correlation to the stock market. They have a lower correlation to the bond market. So gold, commodities, tips, those are all assets that serve as alternatives. And we like them because they're very straightforward. They're liquid. They're transparent. So we like the idea of holding assets that have a low correlation, that have the trappings of alternative investments. And we feel like it's such an uncertain period right now. We want to have a good percentage of assets there. But if you do that, you have to get up and look yourself in the mirror every day and say, you know what, we're not going to keep up with the stock market, but we'll take that because we're really playing the long game here.
Out of curiosity, everything that we have discussed here, every concern we have, all the things that are leading to what you consider the likely scenario, soft landing. We have not mentioned basically one thing that spins the fan on headline news. We haven't talked about the election. We haven't talked about wars going on around the world, all the rest. Are those things only that can derail what you see happening, or are those things legitimate concerns, or are those things talking points for somebody else? Because if you're a long-term investor, there's always something going on.
Well, I mean, the election can be a concern because, it can go off the rails. And the geopolitical situation is very tense. I mean, it's more tense than it's been in decades. We had a very long period of, basic geopolitical calm. We have left that period now. And so that is a real risk. And the risk is obviously if it's taking place in the Middle East, where we're sourcing all this oil and you get a spike in oil, well, that could give Barry Ritholtz his stagflation environment. Now, the probability of that may be low, but that is it's a real risk. I would say most of the time, if you talk about the politics here domestically, that oftentimes it's white hot in terms of the news, and particularly nowadays, but the market usually muddles through it and it doesn't set us back. But the geopolitics, that could have a direct impact, particularly to the extent that it has a direct impact on the energy markets. So that's something that certainly could happen. And you just need to be ready. You just need to be, what is it? Invest in preparedness, not prediction. I think that's very true here.
So investing in preparedness, we have to prepare for the bad stuff that we've been talking about. We've been preparing for it for a long time. And the worst you see happening realistically is soft landing. So if you're wrong, but you're wrong, to the downside, and the truth is this continues, not necessarily with no landing, but just no landing for longer. How exciting is that? Like, is that anything that people should be going, wow, never expected to see my portfolio crossing this numbers at this time. Look at how good it's doing. How much? Because we know that people want to internalize that. Should anybody get excited if better than expected is like everything else has been good longer than expected?
Yeah, I mean, I would listen, we'd rather have the market go up than down. I mean, we're cautious by nature. We really focus on risk management and preserving our clients' assets and keeping them safe. And because we do that, we have to forego some of the returns that are out there. We understand that, and we, make sure that our clients understand that's why they're invested with us. So, if we get, let's say, inflation doesn't get down to the 2% target, but it gets down to 2.75%, 2.5%, and the Fed can say, well, we're still trying to get there, even though they're pretty okay with it being at 2.5%, and the economy can continue to grow, and maybe we have a short recessionary period and the labor market, continues to soften, albeit slowly. That's fine. The economy can do well in that environment, and the market can continue to do well as well. Again, the thing that always gets you is the thing that you're not expecting to happen, but it seems obvious after it occurs. And, that's difficult to prepare for those risks, but that's what we do at 3 Edge. That's why we're diversified. That's why we focus on risk management in all our strategies.
And of course, like you said, it's time to be focused on those things. It's always time to be focused on those things.
Exactly. Yeah.
Fritz, great stuff as always. Thanks so much for joining me on the show to talk about it.
Chuck, you're the best. Thank you for having me back.
That's Fritz Folts, everybody. He is Chief Investment Strategist at 3 Edge Asset Management. 3edgeam.com, the website, on Twitter or X at 3edgeam.